Tensions have escalated between President Donald Trump and Federal Reserve Chair Jerome Powell, as Trump expresses a desire to terminate Powell over disagreements on monetary policy, particularly regarding interest rates and tariffs. Chicago Fed President Austan Goolsbee warns that such a move could severely undermine the credibility and independence of the Federal Reserve, a crucial aspect of effective economic governance. The conflict stems from Powell's criticism of Trump's tariff policies, which he argues could lead to increased inflation and slower economic growth, while Trump accuses Powell of mismanagement and calls for lower interest rates to stimulate growth. The situation has sparked a broader debate about the independence of the Federal Reserve, a principle essential for managing monetary policy without political interference. Economists, including Goolsbee, stress the importance of maintaining this independence to prevent economic instability, drawing comparisons to other countries where lack of such autonomy has led to negative outcomes. Despite the tension, Powell remains confident in the support for Fed independence within Washington. Market reactions have been muted due to the Good Friday holiday, but there are concerns that political interference could lead to increased inflationary pressures and market volatility. This underscores the critical role of central bank independence in maintaining economic stability. Meanwhile, investors are also focused on upcoming first-quarter earnings reports from major companies, which could shift attention away from the current discourse on tariffs and Fed independence.
Mechanize, a startup founded by AI researcher Temeh Besiroglu, has announced an ambitious initiative aimed at achieving full automation of the economy. The company intends to develop virtual work environments and training data to enable the comprehensive automation of labor, a move that could potentially disrupt the global job market. Mechanize's vision is to harness AI to automate everyday labor tasks, which Besiroglu argues could lead to unprecedented economic growth and improved living standards. The startup is supported by notable investors, including Nat Friedman, Daniel Gross, and Patrick Collison, highlighting significant interest from prominent figures in the tech and finance sectors. The implications of Mechanize's goals are profound, as the company targets a market where workers globally earn approximately $60 trillion annually. By automating these jobs, the startup suggests that vast economic benefits and new opportunities could emerge. However, this also raises concerns about the potential displacement of millions of jobs, echoing broader anxieties about AI's role in the future of work. Mechanize aims to address current AI limitations, such as reliability and context understanding, to fully realize the potential of automation. This initiative is part of a growing trend where AI is increasingly seen as a transformative force in reshaping economic landscapes and labor markets.
The global financial markets are currently experiencing significant volatility, characterized by fluctuations in stock, bond, and commodity prices, alongside a rapid depreciation of the US dollar against foreign currencies. This instability is largely fueled by unpredictable policy changes from the Trump administration, particularly the imposition of tariffs that threaten to disrupt global supply chains and exacerbate inflationary pressures. These tariffs, targeting goods from Asia and impacting sectors such as consumer goods and pharmaceuticals, have raised concerns about increased costs and potential shortages, with notable figures like Mark Cuban warning of life-threatening consequences due to higher medication prices. The recent two-day 10.5% plunge in the S&P 500 has intensified fears of a trade war with China, reminiscent of past financial crises. Despite the immediate market turmoil, historical data suggests that such downturns can present lucrative opportunities for long-term investors, as evidenced by an average gain of 27.2% a year after similar declines. However, caution is advised due to the current high market valuations and the potential limitations on the Federal Reserve's monetary policy options. Investors are grappling with uncertainty, with some opting for traditional buy-and-hold strategies, while others explore short-dated options to capitalize on rapid market swings. The sentiment ranges from cautious optimism to despair, prompting strategies like paying down debt or shifting investments towards gold and foreign stocks. Meanwhile, the administration's economic team is exploring a transition from aggressive tariff strategies to negotiating trade agreements, which could stabilize markets if successful. In this complex landscape, the decision to invest in stocks or bonds should be guided by individual financial goals and timelines. Historically, stocks offer higher long-term returns but come with the risk of severe drawdowns, while bonds provide stability but are susceptible to inflation risk. A balanced portfolio approach, such as a 60-40 mix, can help manage risk and returns based on personal circumstances. Investors are encouraged to adhere to their financial plans, considering both the potential long-term benefits and the distinct nature of the current economic environment.
Netflix, NFLX reported robust first-quarter results, driving shares above $1,000 in after-hours trading, reflecting a substantial recovery from recent lows. The company exceeded expectations with a 12.5% year-over-year revenue increase to over $10.5 billion and an operating margin improvement to 31.7%. Earnings per share surged to $6.61 from $5.28 in the same quarter last year, propelled by higher-than-anticipated subscription and advertising revenues. This performance underscores Netflix's strategic focus on enhancing its content slate, expanding its advertising business, and exploring growth initiatives like live programming and games, which are pivotal to its 2025 priorities. Looking ahead, Netflix projects second-quarter revenue growth of 15.4% year-over-year, reaching over $11 billion, with an anticipated operating margin of 33.3%. This optimistic outlook is supported by expected benefits from recent price changes and continued growth in subscribers and ad revenue. Despite the strong fundamentals and growth trajectory, the stock's current high price-to-earnings multiple in the high 40s suggests that investors might exercise caution before buying, as the valuation reflects not only the strong growth forecast for 2025, but also assumes sustained exceptional performance in the future. For existing shareholders, the results reinforce the long-term bullish outlook, though the stock may not present an immediate attractive entry point for new investors.
The financial landscape today highlights a dynamic shift in the cryptocurrency market, driven by technological advancements and strategic governance decisions. Web3 AI is making waves with its pre-sale, offering a significant potential return of 1,747%, as it leverages AI-powered tools to enhance decision-making and risk management in crypto investments. This initiative is not just about generating profits, but also about providing real utility through features like an AI trading assistant and a crypto scam detector, positioning itself as a key player for investors focused on long-term blockchain utility. The platform's pre-sale success reflects a growing institutional interest and hints at a broader trend where AI integration in crypto could redefine market strategies. Simultaneously, Sui and Render are navigating pivotal developments that could influence their market trajectories. Sui's price action, characterized by a wench pattern, suggests a potential breakout, bolstered by its partnership with Greece's national stock exchange to create an on-chain fundraising platform. This partnership enhances Sui's real-world utility and has contributed to a stablecoin supply reaching an all-time high of $746.81 million. Meanwhile, Render is undergoing a crucial governance vote on Proposal RNP-019, aimed at updating its emissions framework to include AI-driven compute partners. The outcome of this vote, while not directly impacting price, could significantly affect investor sentiment and platform engagement, indicating the growing importance of governance in shaping crypto project directions. Overall, these developments underscore a shifting focus from mere speculation to strategic utility and governance in the crypto space.
NVIDIA, a leader in AI chip manufacturing, experienced an 8.5% decline in its stock price during the week of April 14 to 18, closing at $101.49 per share. This drop was notably steeper than the broader market declines, with the S&P 500 and Nasdaq Composite indices falling by 1.5% and 2.6% respectively. the company's stock movements were primarily influenced by two significant events: a positive announcement about U.S.-based AI supercomputer production and a negative impact from expanded U.S. export controls affecting its H20 chip sales to China. On Tuesday, NVIDIA's stock rose by 1.3%, following news of its initiative to manufacture AI supercomputers in the U.S. through partnerships with companies like Taiwan Semiconductor Manufacturing Company, Amkor, and SPIL. This move is part of NVIDIA's strategy to produce $500 billion worth of AI infrastructure domestically over the next 4 years, enhancing its manufacturing capabilities and potentially insulating it from geopolitical risks. However, the stock plummeted 6.9% on Wednesday after NVIDIA disclosed it would incur up to $5.5 billion in charges due to U.S. export restrictions on its H20 chip to China. These restrictions, part of a broader national security policy, impact NVIDIA's ability to fulfill existing orders and manage its inventory, significantly affecting its projected fiscal performance. The financial implications of these export controls are substantial, with the charges equating to approximately 12.8% of NVIDIA's forecasted revenue for its fiscal first quarter. Despite this setback, NVIDIA's long-term growth prospects remain robust. With potential revenue growth of 48% year-over-year, albeit lower than the anticipated 65%, the situation underscores the ongoing challenges tech companies face amid geopolitical tensions and regulatory changes, highlighting the importance of strategic manufacturing decisions and market diversification.
The current property market dynamics highlight the importance of strategic partnerships in home buying, as demonstrated by Jem Korish and Tom Vosper, who are pooling resources to purchase their first home. The duo plans to convert their property into an investment after a year of cohabitation, aiming to capitalize on the rising market in Southeast Queensland. This trend of collaborative buying is gaining traction as individual borrowing capacities often fall short of the escalating property prices, particularly in desirable urban areas. The Home Guarantee Scheme, which allows first-time buyers in Brisbane to purchase homes up to $700,000 without lender's mortgage insurance, is a critical enabler for such ventures. The political landscape is also influencing the property market, with the opposition proposing to relax home loan approval rules if they win the upcoming federal election. Currently, the mortgage serviceability buffer stands at 3%, a safety measure ensuring borrowers can meet repayment obligations. A proposed reduction of this buffer could significantly increase the affordability of additional suburbs, notably impacting areas like Eaton's Hill. However, experts like mortgage broker Luke Ashby caution that while easing lending restrictions may temporarily increase access, it could inadvertently drive property prices higher, necessitating more comprehensive measures such as raising the Home Guarantee Scheme cap to sustainably support homebuyers.
The main financial event discussed is the increasing energy demand driven by artificial intelligence, AI, and its implications on global energy markets and climate goals. Tech leaders, including former Google CEO Eric Schmidt, have urged the U.S. Congress to boost energy production to keep the tech sector competitive, particularly against China. This push comes amid projections by the International Energy Agency that data centers' energy consumption will more than double by 2030, potentially straining power grids worldwide and affecting energy prices significantly. The U.S. government is under pressure to invest heavily in energy generation and transmission to meet these demands, with potential increases in consumer energy costs if these investments fall short. The debate also highlights a political divide, with former President Donald Trump reversing an executive order by President Joe Biden aimed at responsible AI development, emphasizing instead on American AI dominance. The rapid growth in energy consumption poses a threat to global climate goals, with companies like Google acknowledging the potential conflict between their AI ambitions and carbon neutrality targets. However, some experts argue that concerns are exaggerated, pointing to ongoing innovations aimed at improving AI efficiency and reducing its energy footprint. This reflects a broader tension between technological advancement and environmental sustainability, with significant implications for energy policy and market dynamics.
The recent imposition of tariffs by former U.S. President Donald Trump has led to unexpected strategic shifts among Canadian companies, with some opting to bolster domestic operations rather than expand into the U.S. market. Odd Burger Corp, a vegan fast food company based in London, Ontario, has decided to redirect a planned $2 million capital raise from U.S. expansion to developing a new manufacturing facility in Canada. This decision reflects a broader trend among Canadian firms, which are increasingly focusing on enhancing local production capabilities in response to tariffs. This shift is not merely a defensive maneuver. It is also seen as a strategic opportunity to meet the growing domestic demand for Canadian-made products. Ideal Can Inc. and Eco Guardian Inc. are two other Canadian companies benefiting from this shift. Ideal Can, a manufacturer of cans for various uses, has significantly increased production and expanded operations in response to the tariffs, which have unexpectedly improved its pricing strategy by allowing direct dealings with overseas steel mills. Similarly, Eco Guardian, which specializes in compostable packaging, is set to open its first domestic manufacturing facility by 2025, offering a local alternative to U.S.-sourced packaging. These moves underscore a growing sentiment among Canadian businesses to enhance economic autonomy and resilience by investing in domestic infrastructure, which could potentially mitigate reliance on U.S. markets and supply chains.
China has decided to maintain its key lending rates, with the one-year loan prime rate, LPR, at 3.1% and the five-year LPR at 3.6%, as the country seeks to stabilize the yuan amidst ongoing trade tensions with the U.S. The People's Bank of China's, PBOC, decision aligns with market expectations, supported by robust economic data for the first quarter, including a 5.4% GDP growth year-on-year. The LPR rates are crucial as they influence corporate and household loans and mortgage rates in China. By keeping rates steady, the PBOC aims to support the yuan, which has been under pressure due to U.S. tariffs. The decision to hold rates comes despite low inflation and external pressures from escalating tariff threats. Analysts suggest that while there's a case for easing monetary policy, the PBOC is prioritizing currency stabilization to prevent capital outflows. The Chinese yuan saw a slight appreciation against the dollar following the announcement, and the CSI 300 index rose by 0.36%. As China prepares for upcoming economic data releases, including trade and inflation figures, the PBOC's rate decision reflects a cautious approach in navigating the complex interplay of domestic economic strength and international trade tensions.